Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome Tony Javier. Hi, Tony.
Hey, Mike. How's it going?
Did I pronounce your name correctly? Javier, right? That's the right way.
Javier, that is correct. Yeah, people butcher it all the time. Xavier, yep, all kinds of stuff. But you did well.
Thank you for your understanding and flexibility. I just got to double check because sometimes I mispronounce names. And so Tony hails from sunny San Diego, and he has a business in Wichita, Kansas, and he's been a real estate investor for over 20 years. And let me turn it over to you. Tell folks a little bit about Tony. Obviously, where you live, family, married, kids, cats, pets, whatever works for you.
Yeah, absolutely. So I started 20 years ago, and I found a course on TV is how I got started. It's called No Down Payment by Carlton Sheets. I think you probably heard of it, Mike, and a lot of other people have that have been in the game for a little while. So it taught me how to buy properties with no money down. At the time, I was waiting tables in college, doing that whole thing. And then the light bulb went off of like, wow, I can buy a lot of assets very quickly and build a huge net worth and really good cash flow within a short amount of time. At least that's what the system said, right? And so, within I don't know, 3 or 4 months, I'd bought my first couple properties, had my dad co-sign for me, borrowed a down payment from him. And that's where I got started. And so, I've got a flipping business. I've got a rental business. Over the years, it's kind of expanded into multiple things. I own some co-working space. And you said, you mentioned I live in San Diego. My main market is actually Wichita, Kansas. So that's where I started. That's where I have all my real estate, or most of my real estate. And I met my wife in 2012 at a Tony Robbins seminar. And, her coming from Ottawa, Canada, which is the capital of Canada, a very nice place. She moved to Wichita, Kansas, and basically said, this isn't for me. Get me out of here. I need to go somewhere else. And I said, hey, I love San Diego. So it just took me a little bit to get my business set up to where it ran on its own, and we moved to San Diego, California. So that's where I live. I've got a team that runs my operation out there. Again, I've got flipping company, rental company, co-working space. And so recently, and I say recently, within the last few years, I've started, a bunch of other businesses. And, getting in the business 20 years ago, having no money, getting started, I had to find ways to get money. And I raised it through private lenders. So my dad was my first private lender, co-signed for me and put down the first, down payments for me. Ended up, had a friend in high school who inherited a little bit of money. So him and I got together, we did a bunch of deals together. And then just over the years, I've raised, tens of millions of dollars in private money doing deals for my deals. I've done close to 1,000 flips over the last 20 years. And, a couple years ago, I started, on the other side, lending money to other real estate investors and helping them get started with projects. So that's one of the things that I'm really working on hard now is I have a gap funding program where I lend money to other real estate investors as a down payment, and I take a second lien position in the properties. And some people say, well, why do you do that? Why don't you do first lien positions? And the main reason I do that is probably 2 or 3 reasons. One is it's less money out of pocket. So if someone has $200,000, $300,000 deal, I don't have to put a big chunk of money into one deal, right? Whereas the down payment for that may only be $30,000, $40,000, $50,000, $60,000, right? So that's one reason, is to be able to diversify into multiple projects. And then the other thing is that I can earn a substantially higher return on my investment by being in that second position. Now, some people say, well, maybe, it's more risky and all that kind of stuff. But, for me, I'm making anywhere from 5 to 10 times more on second position deals than I would on first position deals. So for me, the risk is worth the reward. So that's kind of where I started 20 years ago, and that's kind of where I am now. And, I just love the real estate game. There's so many opportunities in it, whether it's, buying, flipping, investing passively, lending, all sorts of things. So that's what I do. And that's what I love and breathe every single day.
Yeah, thank you very much for that introduction and a little bit of history and kind of taking us to the gap funding world. I am very familiar with that product, and it's interesting that you kind of took us here, because let's explore this a little further. The gap funding, people ask me, is this a product for you? And I say, I don't have a product that does second lien loans. It's really a relationship. I personally feel that it can work, and it does work when you have very strong borrowers who you know, like, and trust, because you are taking outsized risk by being in the second position. And if you get much higher returns, which it's all about risk adjusted returns, can you capture enough upsides on second with the level of risk you're taking? And in my experience, has always been really the people. Within first, your primary collateral is the property. You're lending at 75% LTV or 70%, and you have safer, but the rate of return substantially lower. So you could magnify the return, as you said, many times that, but you have to take high level of risk, and some of these deals can go poof. So you need to basically earn such a big return so that you can compensate for a few losers you'll have from time to time. Mm-hmm. So how do you do that? I mean, that's the big question. How do you underwrite? Because you're really underwriting the borrower or the principal to make sure that they operate. Number one, they got to have the know-how. Number two, they got to have the integrity. Number three, they got to have the abilities to execute, because they basically highly leveraged. They're giving them money. Their skin in the game is fairly low. So you're basically partnering with them. And my other observation, people who take that money, typically, why they take that expensive money? And there's a reason for this. They don't have the cash. So they don't have the cash. They don't have a strong balance sheet. So just kind of thinking through the process, just talk a little bit more about that.
Yeah, there's probably 10 points that if all 10 points line up, it's a no-brainer deal for me. And I won't be able to cover all of them because I won't be able to remember off the top of my head. But, there's the area the property's in. There's the price point. There's the loan to value. How much are you loaning on the property compared to what the property's worth? There's the experience of the borrower. How many deals have they done? If they've done, I've got borrowers that have done hundreds of deals before, but then I'd lend on some deals where they haven't done a deal before. And, those deals that they've never done a deal before, not everything else, but a lot of other things have to be strong in order for me to compensate for that. So again, if 10 things line up, and then to me, it's like a no-brainer. And if, only, let's say 6 of them line up, then the 6 need to compensate for the other 4 that they don't have. So there's credit score. There's, background check. Background check to me is non-negotiable. If they've got some criminal past and, there's some things that I feel like they're not on the up and up, then obviously, and same thing with the credit. Credit, I'm okay with, a low credit score. As long as it's not habitual, right? I mean, if it's medical bills and there's some things that, happen in their life that they just couldn't really control, then that's not that big of a deal, right? And I think probably one of the biggest things that most people don't think about is just, do they have it together? There's that it factor. When you talk to someone, you probably, seen this, Mike, when you talk to someone, you probably know whether they have their stuff together. It's the way they talk. It's the way they answer the questions. It's when you ask them for documentation, do they send you everything, or do they try and just send you what, they think will just get by and are hiding something? There's that level that when you get into conversations with people, you realize whether do they know what they're doing or do they not? Even some of the most experienced investors I've talked to, if I feel like they're really hard to communicate with, they're not giving me the right answers, that kind of thing. To me, just like you said, the person to me is probably one of, if not the biggest factor, because it doesn't matter whether you have a smoking deal or not. If something goes wrong, if they don't have their stuff together and can't manage the project properly, if they don't, they're not detail oriented to a certain point, then again, doesn't matter how good the deal is, it's going to be really hard collecting from them and really hard, to do business with them. So again, if all 10 things line up, credit, experience, all that kind of stuff, which doesn't usually happen. Usually it's, there's a few things that are missing. But again, if there are some other things that compensate for, like for instance, I've got a deal right now where the loan to value is like 62%, no experience, but they just got a smoking deal. I feel like they have their stuff together. So they don't have experience, but you know what? I'm willing to roll the dice with them because the loan to value is so low. And if I have to take the property back, I could probably, which I've had to do a couple times, I could probably make my money back and then some selling it, once I either rehab it or just clean it up and put it back on the market, depending on where it's at in the project. So yeah, and I love these deals because, like you said, they don't have anywhere else to go for this kind of money. Like there's really no other big company that I know of that does these on a large volume. And that's why I'm trying to fill the gap with that, with creating a company that people can go to where if they've got a really good deal and need to close on it, they can come to us, even though we're charging high rates. They'd rather pay me, $5 or $10 for my money and make 40 grand on the back end than to make, no money at all. Right.
Right. So great commentary. I appreciate a lot of the great nuggets you shared. So I think we're on the same page. I do agree with a lot of the things you said. This underwriting of the person is critical. And then once in a while, you'll have a deal that is low LTV, right? You can be in second position on a low LTV deal, then the collateral itself looks solid. I mean, that's a great setup. Still, at the end of the day, you're working with a person who you need to have built know, like, and trust. That's why, in my opinion, it's a relationship, not a product. It's almost, again, my 2 cents, it's hard to underwrite and start this relationship on a gap funding basis. When we know somebody and we've done a number of deals with them, we see exactly how they communicate, the integrity, ability to solve problems, all those things reveal themselves as you work with them. And then you get to pick and choose people who you can continue to work with and obviously screen out those who are not the right fit. Mm-hmm. So, but it takes a little bit of time, and that's that initial phase. If you're picking the new relationship and you're trying to develop it, is where you have to be extra careful. But I everything you said makes a ton of sense. Let's now continue this conversation a little bit. So, what do you typically charge when you do a second? Do you do equity share? Do you have also a rate on the loan? Just curious, how do you do that? What do you charge them?
Yeah. So what I do is I do a flat fee, typically for the money. So, I like to find deals that in the beginning, when I was doing these, 2 or 3 years ago, I think it was about 3 years ago, I started doing these loans. I was taking on anything that made sense from a LTV standpoint, loan to value standpoint. But now I've kind of, over the last 3 years, really refined down to what were the easiest deals that I did and what made the most sense. So, I did a couple deals where there were big renovations, they were additions and that kind of thing, which ended up working fine. They ended up going from 6-month projects to 14. So I was able to make, money over the whole 14 months and do, whereas if I would have gotten cashed out in 6 months, had to find another deal and that kind of thing. So it worked out fine, but it was a newer not a newer investor, but investor that was new to me, that when things started going not sideways, but like, the permits weren't going correctly and the contractors were having issues, that I didn't know if I was going to have to take back a project that, had a shell and wasn't completed. Right. So for me, I like to do the more simple deals. That's like, carpet, paint, cosmetics. I typically don't like to do additions anymore, that kind of thing. So I charge anywhere from just a flat fee to a profit share deal. So a profit share deal to me is, over the years, as I've done these, I've realized that newer investors just need way more handholding. Something happens with a contractor, I'm typically coaching them through it. If they can't make the payment on the first loan, then I may have to step in and help them and make that payment, just because, they don't have the assets, right? So they're not bad people. It's just, they're very green. So on the low end, I charge anywhere from, or I charge a 20% fee to use the money for 6 months. So that's a 40% annual ROI minimum. And what I do on those deals is I actually bring investors in to participate on those deals, and I'll give them half of that fee for bringing in the money. And my job is to find the deal, underwrite it. I invest my own money in these deals, and I underwrite it as if I'm investing my own money, even if I bring other people to invest in these deals as well. And then if anything ever goes sideways, south, I need to collect, I need to take over the project, I'm doing all the work. So if I invest that money into the deal, then I'm getting a 40% ROI minimum. Most of the deals I'm doing that I invest in are about 60 to 80%, 60 to 70%, I would say average. And I've got deals that are over 100% to 200% return, because I'm doing profit sharing on those deals. The newer investors that don't have a deal under their belt, but they've got a really good deal to present to me. I've even co-signed on loans before because the deals were that good. And for that, I need a profit share of the deal. It's anywhere from 25 to 50%. So people will say, well, why would they pay this? Why would they pay these rates? Why would they pay this money? And again, like, there's typically $30,000, $40,000, $50,000 profit in these deals. And rather than them trying to get the whole thing and not having the money to do it and getting zero, they'd rather pay me 5, 10, 15, 20 grand, whatever the number is, to be able to do the deal than to not be able to do the deal at all. Not only that, but they know how much experience I have. So one of the things is like, okay, if I'm going to come in on this with you, then I want to be a partner in it as well. And I will talk you through anything that you need. I'll show you my systems, my processes, and that kind of thing. So I know it was kind of a long answer to your question, but it's anywhere from, a flat fee for 6 months that can be a much bigger return. Actually, I had one deal where someone came to me for a second position. They ran out of money. The project was complete. I lent them, $30,000, and literally like 2 days after I lent them the money, they got the property under contract and they cashed me out in like 30 days. So the ROI on that was like 200 and some percent. Yeah, I mean, it was a short time frame, short amount, but still, you do enough of those deals, it really adds up.
Yeah, it makes a lot of sense. So the pricing is logical. I mean, we've done gaps. We generally try to charge 40% is steep, but we do seconds, we try to charge between, 24 to 30%. I mean, that range is one of the reasons. Pushing it to 40, it works really. Size of the deal matters, right? On a small deal, it's return on time, not just the investment, right? So 40% by itself, and there's a flat fee on a small deal, there's nothing completely crazy about it. So it makes total sense. And then a profit share with let's just say, amateurs or rookies or folks who you have to do some hand holding makes a lot of sense, because in reality, you're entering into partnership. They brought the deal, you're bringing in the money, you're partnering with them. I mean, that's the way to think about it. But the pricing does make sense. The other quick question that I have, and I've encountered this from time to time, do you ever have to deal with the local laws? I mean, where do you do these deals, and what states? Number one. The second question, if you're doing purely loan, you may have a kind of a user limit, and if you do partnership, it's different, right? I mean, the sky's the limit. You could write anything you want as a partnership. On the rate, there might be some limitations. I mean, usually is rarely ever enforced. But if the deal goes sour and they complain, I mean, you might have to deal with a usury limitation. Even if you charge them 40% and they say, hey, maximum rate in the state is 18, I don't want to pay you anymore. Technically, they can fight you in court, and they're probably going to win. I'm just curious if you ever encountered that situation.
Yeah, it's a really good question. So the only state I don't do right now is Oregon. You're supposed to have and I haven't verified this 100%, but you have to have a brick and mortar office to lend in Oregon, from what I understand. So that's the only state that I'm not doing right now. But the usury law is interesting, because if you look at it state by state, first off, if it's a commercial loan or a loan done to an entity, then usually usury laws don't apply in most states. I would say, I don't know, at least 80% of states are that way. But even the other states that have a usury law, even if it's a commercial loan or to an LLC, you're right. It's typically not enforced, and not that I want to violate the law by any means, but from what my attorney has advised me, my office is in Kansas. So for me, if I'm underwriting loans from my office in Kansas, if I've got an office there and I call that my home office, then I can use Kansas law to lend all over the country. So worst case, and he actually has case law. He looks at case law in states to make sure that's true and correct. So when we go to a new state, he looks at case law and makes sure that it is true and correct. So there might be some states where they don't have, we don't have the cases to prove it. So then we may revert or may not do a loan in that area because we can't charge the rates we need to. But yeah, we underwrite them from Kansas. We use Kansas law. And if anybody ever fought it, then we would just have to go back to the maximum rate. Like Texas, for instance, 18% is the maximum in Texas. And again, we feel like, we can do Kansas loans or loans underwritten in Kansas there and then charge whatever rates we want to. But let's say they come back and say, hey, you should have only charged 18%. We just pay back the money that, that we charge them for that loan. But the chance of that happening is pretty slim. And we feel like, we've done enough research with the law that we can use Kansas law in order to underwrite these loans.
Yeah, great answer. I'm familiar with the concept. It's funny that you said that, but you can do a note in one state and a mortgage in another state. I mean, we've used this technique a lot of times. You can use a Delaware note and subject to the usury exception, commercial loan. There's no limit. Some states like Nevada, a few other ones have no usury limit as long as Nevada is a Wild West, right? Nevada has no usury limit at all. But you can have a Nevada note or Delaware note or Kansas note and a mortgage or deed of trust in that state. So the technique is generally very sound fundamentals. But if you wind up with a loan, in Florida and the borrower is in Florida and the property is in Florida, they can try to challenge you saying, hey, the property is here, Florida law applies versus the Kansas law or Delaware law or Nevada law. But that aside, I think the theory is pretty sound and the approach is very sound too. If you feel you're gonna fight and litigate, just give them the money back and move on. So 18% is not terrible. So understood. So let's just quickly a few more questions. We're kind of running out of time, but how would folks reach out to you if they're interested to invest in some of these deals? Obviously, again, full disclaimer, disclosure. I don't endorse this. We do some of them. It's a higher risk transactions. Anybody who is interested should understand these are second lien loans or equity participation. The risk is higher, but if they work with the right operator like you, they can make outsized returns. With understanding, it's a risk reward type of a balancing act. So, but how would they reach out to you? What's the best way to chat with you, ask questions, look at a potential deal if there's interest?
Yeah, two ways. One would be just go to TonyJavier.com. That's TonyJavier.com. You can learn a little bit more about me and all the stuff that I do for real estate investors. And then if you're a serious investor, an accredited investor, probably more what I'd like to teach and coach how to do this. I'd be more than happy to walk you through some of this. You could email me at tony@prohomebuyer.com. So TonyJavier.com or email me at tony@prohomebuyer.com. Be more than happy to help you and get on a call with you and see how we can help you, invest in some of these deals.
Thank you, Tony. Wisdom is much appreciated. Very interesting subject. I have to say that we used to do a whole bunch of gaps. We're doing limited amount, but we do, especially on commercial deals, that's applicable. That number of, as you said, residential deals, it's still applicable on fix and flips. So the concept is solid. Just the key is to underwrite really well. Can't really stress that. But great again. Any final thoughts? Any parting? Best book, best idea, just final thoughts.
Oh man. I would just say, just final thought would be there's just so many ways to make money in real estate. So if you're sitting on the sideline right now and you've got money to invest, there's so many ways to invest in real estate. I know Mike has funds that he runs that you can invest in and be very passive and, that kind of thing. We've got programs that we invest in, invest people's money and, get them a 10 to 50% return on their money, depending on the deal. And then there's also doing the legwork, which most people probably listening here don't want to do. They probably want the more passive side, but just do your due diligence. If you've got the right person operating, whatever it is you're investing in, I think that's the number one thing to look at, because even if, like I said, even if you have a great deal or someone has a great deal, if they're not a good operator or they're not, don't have the integrity and that kind of thing, then that deal could go south. So first would be the person. Second would be the deal. And then, obviously a lot of other factors after that. So just do your homework and, make sure that, someone has a track record and is able to fulfill on their promises.
Yeah, great feedback. I completely share. The same thing we talk about underwriting. You always start with a person. 2, you start with a deal. And 3rd, you start with economics. So if all three work out, you do the deal. If any of them falls apart, and integrity just cannot be understated. If you start with the wrong person, then you have an adventure with the wrong partner. So
yeah.
Thank you for sharing great wisdom, TonyJavier.com, and appreciate you coming on the show, and we'll chat again soon.
All right. Thanks, Mike. I appreciate you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.